Good afternoon, everybody, or afternoon for those of you on the East Coast, morning, late morning for those of you out west. For those of you that don't know me, my name is Ryan Melliker. I am the president and co-founder of Lodging Analytics Research and Consulting. And we're going to walk through the slide deck here and go through our outlook for the US. But before we do it, and as people continue to file in, I'm just going to go through a few housekeeping items for everybody. Number one, the webinar is being recorded. So if you have to pop out or you want to share it with a friend, you'll be able to do that. We'll have it posted on our website, hopefully by the end of this week at larkanalytics.com. Number two is by now everybody's familiar with kind of how Zooms work, and you've got a Q&A option on your taskbar within Zoom. Feel free to drop any questions in there at the end of the presentation. Katie Harding from my team is going to kind of organize all the questions, and we're going to go through them all. We'll try to get through everything that as much as we have time for. If for any reason we don't get to your question, feel free to reach out to us at information@larkanalytics, LARC analytics.com, and we'll be able to help you with that stuff. The third thing that I'll say is that for those of you that are on the webinar, will receive a copy of these slides. I know we're going to get 5 more questions about getting copies of the slides. You will receive them. We will send them out to everybody after the presentation, so you don't have to worry about that. And then the last thing that I'll say is, for those of you that are interested, we will be at the Hotel Asset Managers Conference next week in New Orleans, and at the Phoenix Lodging Conference in 2 weeks out in, obviously, Phoenix. If you want to try to connect with us, happy to do that there. Or you can reach out to us at information@larkanalytics.com if you want have inquiries about anything that we talk about in the presentation here, or want to learn more about our products and offerings. That being said, we've got a lot to get through, so I'm gonna jump in. Here we go. Maybe. Let's see. There we go. So this is our overview of what we're going to go through today. It gives you a sense of kind of the outlook. We're going to get started with the US market overview real quickly. Those of you that have been on these webinars before, you've seen the slide. What I want to highlight to people, and this is just showing occupancy, ADR, and RevPAR relative to 2019 levels. And what you can see is occupancy right here has kind of not really reached 2019 levels for any prolonged period, but B, has also started to drift down. While ADR, the light blue here, has continued to tick up, but that pace of growth is certainly moderated, leaving RevPAR in between the two. Bottom line is occupancy seems to be a little challenged right now, and we're going to talk about that in a minute. This recovery has been inconsistent. These are the 60 markets that we track currently at Lark, and of those 60 markets, 40 of them in 2022 had a RevPAR that was above 2019 levels, and 20 had RevPAR below. And the divergence is extreme. And when I say extreme, I mean extreme. The Florida Keys and Kauai over here up 50% relative to 2019, over 50% or around 50%. San Francisco and San Jose down over 30%. Massive shift, 80% swing there. So the market that you're looking at really does matter. National focus, as helpful as it may be to give you a sense of where things are going to be from some level of baseline, is going to be very different from one market to another. We've seen that over the past 2 or 3 years, and we're going to see that over the next 2 or 3 years. And this is the same chart from an ADR perspective. ADR, unlike RevPAR, came back much faster. You actually saw ADR up well above 2019 levels in most of our markets in 2022. That was inflation supported, as we're all aware. And again, the variance is extreme. As we look right now, I think one of the things that I want to highlight are some of the data points that we're starting to see right now to give us an indication for the last few months of the year, as well as into 2024. And one of those is TSA throughput. And this is a graph that shows TSA throughput on a 30-day moving average. TSA throughput peaked in February at around 4% above 2019 levels, which is kind of interesting. Oh, okay, things seem to be getting back to normal. And then it started to pull back pretty meaningfully. And a lot of that pullback was driven by the economic concerns. The stock market had pulled back, personal savings rates had dropped dramatically. And on top of that, you had this regional banking crisis that really unfolded throughout the month of March. And certainly was being led into in February with a lot of conversation and concern surrounding it. All of that led to a big pullback in travel trends. Now, fortunately, that was relatively short term, and then things started to stabilize. And now what's kind of interesting, if you go back and look from early August, where effectively where things were low, or even if you even go back earlier, avoid this dip and just say, hey, late June, before things started to pick back up, aside from that one dip there, you'll actually see we were down, throughput was down about 1.5% from 2019 levels, but we've seen this nice recovery, especially in August, where now we're back to looking at throughput about 3% above 2019 levels, getting back to where we were in February, which is encouraging. It's a sign, we believe it's a sign of things to come as things are starting to improve, but we'll talk about that in a minute as well. Hotel booking volumes, another point of encouragement. So to give you an idea, this is booking volumes up here as a percentage of 2019. And the lower line here, the lighter colored line is the US, the darker one is global. And you're seeing booking volumes as a percentage of 2019. And what you can see throughout this year is basically things again were stronger in early part of the year, then started to pull back. Well, we've now, towards the end of August, seen a nice uptick in terms of booking volumes. That's encouraging. It's very encouraging, where we've gone from 83% of 2019 levels in early 2019 back up to 90% of them now. And what's really exciting is if you look at the booking volumes is, only about 15% of the bookings made over the past 2 weeks were made for periods through the Labor Day holiday. So this is all looking forward into the fall. Most of it's going to be in September. We believe this is pointing to an acceleration in travel trends in September on a year-over-year basis, of course, or certainly relative to 2019, not necessarily relative to August, if you will. But it just gives you some sense, some encouragement there. We can talk about this cycle being different. I think this is something that's always interesting. When you look at occupancy recovery of this cycle relative to past cycles, you're going to see that occupancy actually started to decline pre-pandemic. Then it went through the massive fall during the pandemic, came back much more quickly, and now it's largely on par with where we have been in prior cycles of recovery. But I think one of the differences is during those past cycles, things were trending up at this point in time. And here we've got things kind of flattening out at this point in time on a trailing 12-month basis, as opposed to continuing acceleration, which is something that we'll talk about in a little bit. But it's something that we believe is going to persist, which is going to create some noise related to occupancy recovery. ADR, a little bit of a different chart. Again, fell deeply during the pandemic, bounced back more quickly than we had seen any other time. Part of that is obviously inflation oriented, but generally speaking, what we're seeing now is ADR growth on a trailing 12-month basis starting to slow pretty meaningfully, and you get a good sense of that right there. Still well above where we were in prior cycles, but that the trend line that we're starting to see is moderating a little bit, while these guys at this point in time were continuing to trend higher. And as a result, you get a RevPAR chart that looks like this: deeper fall than we'd seen any other cycle, faster recovery, and again, RevPAR largely plateauing right now, whereas we saw massive growth, or not massive, but trending growth in prior cycles at this point following the prior peak. So that gives you a sense of kind of where we are, that the bounce back coming out of the pandemic is now behind us, right? Which we all probably knew to an extent, but this is data that kind of points it all in more of a trend perspective. And from a value perspective, not going to get into the detail of the forecast just yet, but when you think about where things have been historically, one of the things that we really like to highlight about this chart is from 2007 to 2009, values fell about 27%. That's about what we think they fell from 2018 to 2020. Similar dynamic. And then values then rallied all the way through 2018 to the point that 2018 values were 18% above the 2007 prior peak. We believe that right now values have basically gotten back to 2019 levels, still not back to prior peak of 2018, but we do see things getting there, and we'll talk about that in a little bit. Let's talk about our economic outlook and some of the drivers of our US lodging forecast. First of all, return to office. This is data from Castle Systems. Effectively, what you see with return to office data is through August, basically, return to office office utilization rates have remained sluggish at roughly 50% of 2019 levels. This is discouraging, obviously. We think office utilization is a critical component to corporate transient travel recovering, and the lack of office utilization has certainly played a role in the lack of corporate transient travel recovering to date. The good news, we think we might be at a potential inflection point. JLL actually published a great piece about this related to office utilization. There are about a million employees that will be called back to the office in September for the first time since the pandemic. That is a 67% increase of all the office employees being called back for the first time year to date. At one fell swoop in September. September is that point. We're starting to see it. And then this chart shows you Fortune 100 companies with their return to office this year. And what you'll see is the vast majority of that is September timeframe. And a lot of these that happened April, May, June, July, we don't necessarily see it in the corporate travel numbers over the summer, and we're going to start to see it in September. So this is kind of an interesting dynamic that you're seeing it from large companies, you're seeing it from smaller companies, all of the above. Return to office is starting to accelerate. Why is that? Well, I think the answer is right here. During the pandemic, productivity levels were sky high. And C-suite executives and boards said, "Hey, why do we need to bring everybody back to the office? This is working great. People are being productive. Maybe we can shed some costs and allow, and not have to have as much office space." Number one. Number two is our people want to work remotely. So this is a win-win for everybody. But what's happened since that point is that productivity has taken a big drop off. The biggest 2-year decline in productivity on record, according to the Bureau of Labor Statistics. And now executives are saying, "Hey, wait a second. We want to bring everybody back, but we have to make sure that we can bring everybody back. We're not going to face the wrath of our employees, whether it be an employee revolution or people just quitting, all those things." So they had to wait for the employment market to shift enough, which we believe it has. And now they're starting to say, "Hey, we're going to be a little bit more aggressive here." And you're seeing all of this happening. And we think that is going to continue. Do we think this is equivalent to where we were in 2019? Absolutely not. 3 days a week, 4 days a week, hybrid. This is not the same as where we were in 2019, but it is a big improvement from where we were 6 months ago. And as that improvement continues to tick up, it's going to be a positive for corporate transient. The other thing, corporate profits. We talk a lot about, the macro factors that drive corporate demand. Corporate profits in the stock market are two of the big ones, right? When you think about corporate profits are projected to decline 9% this year, and then another 2% next year. That's not very encouraging, right? But corporate transient demand, hotel demand, isn't where we were pre-pandemic. It's not a normalized level. It's still at a recovering pace. In fact, corporate profits this year are still expected to be 15% above 2019 levels. Corporate transient demand is nowhere near 15% above 2019 levels. It's more like 15% below, not quite 15%, but close to 15% below 2019 levels. So when you put that perspective on, you say, well, I'm not as concerned about this decline because we're still in the recovery mode. Same thing can be said for the stock market, right? Stock market was down 19% last year. Oh, no, okay, in a normalized environment, that would be very concerning for corporate travel budgets. But in an environment where corporate travel budgets were so low, incremental growth is positive. And you're still way below 2019 levels, which the stock market is way above 2019 levels, 40% above 2019 levels. And why does that number matter so much? If profits are down and stocks are up, where profits are down 9% this year and stocks are up 17% year to date, that's a dynamic where companies have to grow into their multiples. The way they grow into their multiples is by going out and driving revenues. It's not about cutting costs, it's about driving revenues. And that will help corporate transient demand. So some of these data points say, hey, corporate transient has some challenges. And we would say those challenges will be based on a normalized environment, which is not what we've been in for the last couple of years. And in the environment that we're in, we don't see those as headwinds. And we look at some of these other data points as big positives for corporate transient. We think corporate transient is going to really pick up. So as we said in our client letter from that was sent out on Tuesday, if you saw it, if 2022 or 2022 was the year of leisure transient, 2023 is the year of the group recovery, 2024 is going to be the year of corporate. And it's going to start this fall, and we're pretty excited about that. Now, to give you an idea, here's another point on corporate transient. And this is data from a great note by Patrick Scholes over at Truist earlier this week, where he pulled a bunch of data related to the various demand segments and came up with some interesting conclusions and points that we've been thinking about for the past couple of months. And one of them is based on this TripBam data, which kind of points to US corporate transient demand growth. And this is just volumes, booking volumes of corporate transient. And you can see year over year growth had been slowing. But look, in June, July, it kind of had stabilized. And now it's starting to pick up again. And we're starting to see year over year growth. So you're taking the seasonality away, year over year growth really starting to pick back up. And that's really, so that adds to the SiteMinder data that we have, all the macro points that we're pointing to that say corporate transient is looking better come the fall than we had been expecting 3 months ago, 6 months ago, et cetera. And pricing is also slightly positive. But it's not just about corporate. Group is also particularly strong. 2023 is pacing up 18% versus 2022 for the 30 largest convention centers across the US. That is a great number. It's actually on par with 2019 levels. And importantly, 2024 is only pacing down 2% year over year. Now, 3 months ago, if you watched this webinar, you would have heard me talk about 2024 being a concern with convention center pacing down 11%. Well, in 3 months, we went from down 11% to down 2%. 9 percentage points of pace improvement across the largest convention centers in the country in a 3-month period. That points to the idea that conventions are aggressively coming back. Group is improving in a massive way. This is all very, very, very positive. And it points to 2024. Maybe it's not going to be up relative to 2023, but it's not going to be down a lot either. And we're already back to 2019 levels from a convention pacing perspective. So group is going to continue to be strong. We're pretty encouraged for group as we move into the fall here, as well as the first quarter of next year. Unfortunately, leisure doesn't give us the same, warm, excited feeling as we get from corporate right now, and to a lesser extent group. Leisure was really, really strong, right? We all know how strong leisure was coming out of the pandemic. This is kind of an interesting chart and just something that we want to highlight. So what this light blue line is the share of the wallet of the consumer wallet allocated to hotels or accommodations and food service. Okay. And it normally hovers around the 6.5% level, right? During the pandemic, it dropped dramatically, right? Because nobody was staying in hotels, nobody was eating out, right? Everybody was trapped. It dropped dramatically. And as a result, what happened? The personal savings rate spiked, right? And you had the highest personal savings we had ever seen, right? Well, what happened immediately following the pandemic? Oh, I've got all this money and I haven't spent any of it on hotels. I'm going to go travel. And that personal savings rate plummeted, and that share of wallet spiked and went back, right? Super fast, really, really quickly, these things changed. So where are we going? So what if we look at all of this data? I think the one thing that it tells us is that there is a negative 80% correlation between the personal spending share of wallet on food service and accommodation and the personal savings rate. So as the personal savings rate goes up, that share of wallet goes down. As the personal savings rate goes down, that share of wallet goes up, right? And understanding that dynamic. Well, what's going to happen with what's expected to happen with the personal savings rate? Well, we've been super, super low, right? And as that ticks up, you're going to see continued challenges as people save, and as they save, they spend less on they'll spend less on accommodations and travel, and until we get to a more stabilized level over the next 3 years, and then things will stabilize. So basically, for the next 9 months, we think leisure travel on a year-over-year basis is going to continue to face some challenges. It's got really, really difficult comps, coupled with this dynamic of personal savings rates rising, will weigh on spending into hotels. Good news, inflation is moderating. We all know this to an extent, but Moody's and the Fed both have pretty positive views on where inflation is going by year end this year and into next year and the year after. All very, very encouraging. And base rates are stabilizing, believe it or not. Expectations are generally now that the Fed is done raising rates. Over half of the economists surveyed by the July Wall Street Journal Economist Survey expect the Fed to be done raising rates for the cycle. And more importantly, 90% of those economists believe that the Fed funds rate will be lower in June of 2024 than it is today. So even if there's another rate increase here, we're going to see pullbacks in rates sooner, more likely over the next 12 months than there are increases. And that's really encouraging. We haven't been at that place over the past year and a half or so, or during this rate increase cycle. And to give you some perspective, Moody's Analytics expects the 10-year US Treasury yield to moderate slightly from the current level and stabilize around 4%. So stabilizing base rates is a positive for the economy, and it's certainly a positive for cap rates and a positive for the hotel industry. But it's not all roses when it comes to the economy, aside from leisure travel being challenging. The implications of the bank failures from this spring are real. We talked about it a little bit last quarter, but good news is we are less concerned, but not concerned about this. So as everybody knows, in the spring, 3 banks failed. They had over $500 billion in assets. It's not those 3 banks that concern us. What concerns us is the implications to the banking system that followed. And the banking system did a great job preventing systemic failures. But the reality of what happened coming out of that was a critical tightening of lending standards across all banks and all types of loans. We're not talking about hotel real estate. We're not talking about real estate in general. We're talking about loans. And what has basically happened is we've seen a massive increase in lender tightening. And as lenders have continued to tighten, going from here loose to super tight and continuing to tighten, and the expectations are that lenders will continue to tighten through the 3rd quarter of this year. As that continues, what it does is it makes it harder for businesses to get loans to fuel their growth and fund their growth. And if they can't fund their growth, they don't grow as quickly. If they don't grow as quickly, the economy doesn't grow as quickly. If the economy doesn't grow as quickly, you don't see that same level of economic growth that will drive hotel performance that we would like to see. And, as we all talk about economic growth being the driver of hotels and looking at GDP. So this is a concern. The other thing that we would highlight about this is, we've seen standards in the lending standards tightened, by 46%, right? Percentage of banks tightening lending standards was 46% in 2Q 2023. And as we said, they're expected to continue to tighten, right? Well, in each of the last 3 periods when percentage of banks tightening lending standards exceeded 40%, a recession was either underway or followed shortly thereafter. That's not a great statistic. It's not really encouraging, right? We expect these issues to impact economic growth, whether there's a recession or not. It may be a matter of semantics, but there's no doubt it's going to weigh on economic growth in the fourth quarter into early 2024. And it's just something to be mindful of. So along those lines, we talked about the concerns with economic growth. Moody's expects GDP to be up 2% this year. Decent growth, not great growth. But next year, it's only up 1.3%. That is low growth. To give you an idea of how low that growth is, over half of the calendar years which have included a declared recession since 1970 have experienced higher GDP growth than 1.3%. Let me say that again. Over half of the calendar years which have included a declared recession since 1970 have experienced higher GDP growth than is expected for 2024. So recession to being declared or not may be a matter of semantics. This is sluggish, anemic growth. And that is going to weigh on hotel performance. There's no doubt about it. Unemployment, you see where we are there. We talked about inflation. We talked about interest rates. Bottom line is Moody's is not calling for a recession, but we are calling for anemic growth. And what would change that? Any of these things, whether that credit crunch that we talked about expands, Fed continues to increase raising rates, inflation ends up reaccelerating, which is a concern, or any new COVID-19 variants that have an impact on, lifestyle and how people are reacting. All those things could lead to a more severe recession or a recession versus not having one. But regardless whether there's a recession or not, this is sluggish growth that we're coming into, and we have to be mindful of that. So key economic assumptions, we talked about the Fed's rate increase cycle, inflation, there's no systemic financial risk related to recent bank failures. Federal government will avoid a debt limit breach. Labor supply constraints will continue to ease. There's no new variants. Russia-Ukraine conflict doesn't expand into the West. And as a result, we look at recession risk moving into 2024. It's not built into our base case, but like I said, that may be a matter of semantics. So let's talk about the U.S. lodging outlook. So I gave you some of the macro data surrounding the three core demand segments: corporate, transient, group, and leisure. Here's where we see things going regarding corporate, transient, group, and leisure. Corporate transient has gradually recovered. It really fell off and was slow to recover. 2022, we estimate, was still about 20% below 2019 levels. We forecast corporate transient demand to increase, increase this year, get close to that, 10% below or 90% of 2019 levels this year. It'll slightly exceed that in 2024, but ultimately stabilize somewhere in that 90% of 2019 levels. Group on the other, and a lot of that's just driven by the lack of people in the office. If people aren't in the office 5 days a week or as much as they were in 2019, the corporate transient to go visit those people and have meetings with those people is less likely to materialize, or those trips will just be cut short by a day. And as those trips are cut short, it has an impact on overall corporate transient demand, plain and simple. Group on the other side will be a beneficiary of that. We believe as corporations don't have people in the office all the time, they're going to try to get their people together more frequently. And that's going to happen by either having, in-house corporate group events, maybe local, maybe more retreats, or bringing more people, more members of a team to a conference or convention because they want to get those team members together from a culture and bonding perspective. You put all that together, we think group is going to stabilize about 10% above where it was in 2019. We've seen a sharp recovery and things are really looking pretty sharp, pretty positive from a group perspective right now. We're pretty encouraged by that. And keep in mind, this is just volumes. This is not pricing. And then lastly is leisure transient. So we talked about leisure. We all know some of the detail behind it. 2021, we estimate leisure demand was 65% above 2019 levels. 2022, it had pulled back, but still close to 40% above 2019 levels. We think it moderates further in 2023, as we've already seen. And overall, we expect leisure demand to stabilize somewhere around 20% above 2019 levels. Now, basically, if you look at where we were here in terms of demand segments, everything kind of even at that 100% level, we saw massive divergences through 2020, 2021, 2022. We look at 2023 as obviously divergences have continued, but this is almost kind of like that new normal of what we see things going forward with leisure corporate and group kind of all hovering around where they are in 2023. So we have kind of 2023 is going to be that new normal of the demand segment outlook as opposed to where we were pre-pandemic. Supply is muted. We expect it to continue to be muted. Top chart here just shows supply growth as defined by STR, or CoStar, which takes into account all the temporary closures in 2020, which is why we have negative supply growth. Then we have economic supply growth at the bottom. The economic supply growth at the bottom just adjusts out temporary closures. One thing that I'll highlight here is our numbers have come down a little bit for supply based on closures in New York related to migrant housing. To the extent that that reverses, and we're not saying it's going to reverse, we don't necessarily assume it's going to reverse, but we could see supply pick back up if that happened. But we're assuming that that several hotels are out of inventory effectively permanently as a result of the migrant housing. But overall, supply is very benign. Here is our RevPAR model for the US. The dark blue line that you see right here is actual RevPAR as reported by STR on a seasonally adjusted basis. The light blue line is the model that we've built to forecast that RevPAR. Got a 99.6% R squared. You can see how that current model has tracked RevPAR across the market historically. Highly accurate model. Here's the primary drivers of those of that model. And obviously you can see where it says things are going. Same thing for ADR. Dark blue line is the actuals on a seasonally adjusted basis. Light blue line is the model that we have built to forecast those actuals historically, as well as moving forward, 98.7% R squared. And again, here are the model drivers. So here's the actual forecast from Lark, right? On the top line, occupancy, ADR, RevPAR. Bottom line is we expect occupancy to be up 1.6% this year to 63.6, ADR to be up 4.4% to 155.80, and RevPAR to be up 6.0% to 9902. 6.0% is a little bit lower than where we were a quarter ago, but we'll get to the quarterly breakdown in a second. Moving forward, we expect occupancy to basically hover around in that 63-64% range. We don't actually have it breaking 64% over the next few years. That is very different from the other forecasters out there that are all north of 64%, some of them north of it next year. We are not there. We are not of that view. We think occupancy levels in general will stabilize below prior cycles. And that's just points to that corporate transient dynamic that we've talked about. ADR, however, is going to continue to be strong, and we remain pretty positive. And in fact, our ADR and RevPAR outlooks are the strongest in the industry for 23 and 24. But we expect the sluggish economic growth in 2024 to catch up to the industry in 2025, and we've got very limited growth in 2025 before we see growth pick back up in 2026. That gives you an idea of where our top line forecast is now. We look at the quarters. I think one of the things that's really interesting is obviously 1Q RevPAR was really strong, up 16.7%, tied to really soft comps related to the Omicron variant from 1Q 2022. We saw a massive reduction in RevPAR in 2Q, and we were expecting that. RevPAR pulled back to 2.5% year-over-year growth in the second quarter. We had actually forecasted 1.3% RevPAR growth. So what I thought was really interesting was when some of the other forecasters out there came out and said, hey, you know, we're lowering our numbers because 2Q disappointed. And I'm sitting there wondering, well, why did 2Q actually beat our numbers? Came in a little better than we had expected. And, you know, we knew things were going to be really soft. We saw that 2Q faced really, really tough comps. But as we move forward, a lot of what we saw in 2Q came to fruition, and it did a little bit better than we had even expected. Where it was better was really on occupancy. Occupancy ended up not being as bad as we had thought it was going to be in the second quarter. But moving forward, because of some of these economic concerns that we highlighted, our numbers are more muted than they were a quarter ago. Not tremendously more muted, but a little bit more muted than they were a quarter ago. And we're basically expecting 4% growth in the back half of this year. Now, what could happen, what we wouldn't be surprised, because this 4% is heavily skewed to corporate and group. We think it's really September through November that we're going to see the strong growth. So is it possible that 3Q ends up a little bit lighter than that 4% and 4Q ends up a little bit heavier? Absolutely. But net, we feel pretty good about our numbers and where they're coming out at, which is well above where everybody else is, because everybody's concerned about the 2Q numbers driving the results moving forward. But we also know that those 2Q numbers don't take into account what's happening from a group and a corporate transient perspective that we're seeing over the next few months, which is what's giving us more optimism, if you will, or at least confidence in the back half of the year. When you look at price classes specifically, in 2023, growth is going to be strongest in the upper upscale and upscale segments. This is group and corporate transient, right? Going to be weakest in mid-scale and economy. It shouldn't be surprising, right? And more oriented to that leisure demand as that leisure demand wanes. Relative to 2019, you're going to see a very different picture. Luxury, which is only up 2% this year, is still the strongest relative to 2019 this year. Upper upscale and upscale, which are going to see the strongest growth this year relative to 2019, are still the two segments that have recovered the least, or expanded the least, if you will. So just something to keep in mind as you think about the segments. A lot of this is really driven by our demand segment dynamic that translates into the price classes. Now, in terms of our forecast, why should you rely on our forecast versus everybody else's? Well, obviously, we showed you the accuracy of our models already. But one of the reasons why those models are accurate is because we're using the best available data out there. And that's something that's very different than I think what a lot of the other guys do. We believe our mantra kind of at Lark is better data in equals better data out. So we use historical operating results from STR and CoStar. We love their historical data. We think CoStar's got great historical data. We're big fans of it. Very helpful. There's another player out there. I don't want to disparage anybody, but we think CoStar is by far the best from a historical data perspective. We think Moody's is by far the best at the market level economic forecasting. We are the only forecaster to incorporate convention pacing data into their numbers. I don't understand why others don't. It's kind of important. Can you imagine buying a hotel in San Diego, in downtown San Diego, and not knowing what the convention pacing is going to be? Or in San Francisco right now with Moscone, kind of important, right? Especially after Moscone just lost another big convention to Las Vegas. This was the Google convention that came out earlier this week. So we get that data as well. We do a ton of work on supply ourselves. You get the idea. Better data in equals better data out. And fortunately, it's led to better results. And here's forecasts at the national level. This is 2022 going into the year for the year. So as of December 2021, our forecast for 2022 versus the actual results and everybody else's. We were the closest in occupancy. We missed occupancy by 30 basis points. We were the highest of everybody on ADR, and it wasn't really that close. I think the closest anybody was $6 from us. We were well above everybody on ADR, and we came in light on ADR. There's no doubt about it. But we also warned our clients that we thought our ADR outlook might be light because we are data driven. We don't subjectively adjust our models and our forecasts. So rather, in our December 2021 client letter, we warned our clients, hey, we think there's more upside risk than downside risk to our ADR outlook, even though it's industry leading, because we don't think our models can fully account for the impact that elevated inflation is going to have on ADR, because we have not seen this level of elevated inflation for the history of having hotel industry data. But we saw more upside than downside risk, and obviously that's what played out. Nonetheless, we were still the closest on occupancy, closest on ADR, and closest on RevPAR in 2022. And if you think 2022 is an anomaly, there it was again in 2021. And at the market, if you think we're doing this at the national level and it's unique only to the national level, trust me, it's not. We do it at the market level as well. Each one of we outperform at the market level too, in terms of forecasting. So let's move into going beyond the top line. So let's look at expenses and EBITDA. So good news here. Finally, some good news on the wage front. Wages are easing. Yay. This is going to help the industry tremendously. The outlook for wage growth from Moody's Analytics is coming down pretty dramatically. We're going to be hovering around 3% annual wage growth, which will be great. Obviously, union hotels, certain markets. Los Angeles has some major issues going on right now with wages. New York is going to have them in the not too distant future. Be mindful of some of those things, but nationally speaking, wage growth is subsiding, and there's a little bit of breathing room. Property taxes are continuing to go up. That shouldn't be a surprise to anybody, as well as insurance costs that are increasing at catastrophic levels. Fortunately, wages are the one that really drives the most performance across hotels. So getting this breather here will help a little bit. Overall, we put all the expense growth numbers together. We've got annual EBITDA growth that's basically going to be up 4% this year, 4% next year. And then on that slowing RevPAR growth in 2025, we've got a slight pullback before things kind of stabilize from a hotel EBITDA perspective. And relative to 2019, we expect hotel EBITDA to be about 15 to 16% above 2019 levels next year before it drops to 13 to 14% in the years that follow. Let's talk about cap rates. So when you think about cap rates, there's the intuitive aspects and then the less than intuitive aspects. And when we think about the intuitive aspects, obviously cap rates have risen. But if we focus on the data tells us, historically, cap rates have risen, but they don't necessarily rise related to base rates. But we all know that's not necessarily the case right now. So what's happening, right? What's the data telling us? Well, what the data is telling us is if we go back historically, there is almost no relationship, whether you look at it on a quarterly or on a rolling 4-quarter basis, between cap rates from CoStar, hotel cap rates, and the 10-year Treasury yield. Okay, there's literally a 0.1% R squared, negative 3.1% correlation, or on a rolling basis, negative 0.9% correlation and 0.0 R squared. No relationship. Why is that? Well, that's because if you think about it, interest rates increase the cost of debt, which translates into a higher cost of capital, and thus cap rate should expand, right? But prior to these past couple of years, when interest rates have typically increased, been during times of economic stability and expansion. Interest rates increase, which is exciting, and that they increase because, the economy's doing well, you've got to pay people more to get them to a lower risk asset of bonds. So then interest rates, so base rates go up, right? During those times, because there's strength in the economy and confidence in the economy, equity premium, or the cost of equity, compresses. And for simplistic sake, we're going to refer to the spread between a 10-year Treasury yield and the US cap rate as that cost of equity, right? And what you see here is that when base rates have historically gone up, that spread has compressed. And not only has that spread compressed at a negative 94% correlation or an 88% R square with an 88% R square, it's done so in almost at the exact same time, in almost the exact same amount. And to give you an idea, if I invert that spread, you'll see just how close those two numbers are. So what's different now? What's happened? Well, this interest rate increase cycle has come during a period of economic volatility and uncertainty. Stock market has, dropped dramatically in 2022. We had a regional banking crisis in March, got a war in Europe, all these massively high inflation and all these fears tied to that. You put it all together, and we saw spreads not contracting. The equity risk, if you will, wasn't contracting during a period of rising base rates for the first time in decades, and that led to hotel cap rates expanding. The good news is here we are for the first time this summer at a period where the economy is doing a little bit better. There's less risk. Yeah, things may be sluggish, but it's going to be a soft landing overall, and things look pretty good. And now we're going to start to see those spreads come in a little bit, even if base rates don't. So that's encouraging. And that's kind of what you see here with our cap rate model that has a 98.4% R squared, is that you're going to see cap rates ultimately stabilize back to where they were pre-pandemic, if you will. And here's the factors that drive that cap rate model. So putting it all together to our overall forecast, what you'll see effectively this year, we've got RevPAR up 6%, hotel EBITDA up 4%, values up 8%. Over the next couple of years, we've got decent growth in 2024, and then it slows in 2025. So over a 3-year basis, things wane a little bit, and over a 5-year basis, things wane a little bit. Shouldn't be too surprising. Change from last quarter is really just driven by occupancy, where we've gotten a little bit more cautious on the occupancy front. ADR is effectively the same. That reduction in occupancy is having an impact on our EBITDA. But because of our outlook for cap rates, it's not having an impact. Our values actually move slightly higher. So getting back to hotel values, we talked about where we were in prior cycles. Now, if you look at, in 2022, values grew by 5%, or just 1% shy of 2019 levels. We forecast values this year to exceed 2023, and they'll exceed the 2018 prior peak next year in 2024. But that's where they're going to peak. And that's where we're going to basically plateau, slightly decrease from those levels in the years that follow. Let's talk about markets, right? All right. So here's the 60 markets that we track on a quarterly basis. We issue these reports every quarter. So you're welcome to purchase them if you're ever interested. And we also do a lot of work on a bunch of other markets on an ad hoc basis for our clients all the time. Before we jump into the markets, I want to just highlight something real quickly. We talked about kind of the U.S. economy and why that's important. We'll take a look at this. If you look at year-over-year lodging demand growth and year-over-year RevPAR growth and compare it to year-over-year U.S. GDP growth, what you basically see is in the 20 years leading up to the pandemic, there was a very strong relationship. Demand, RevPAR, both had really high correlations and fairly high R-squares. During the pandemic, that number even was super high nationally because they had nothing international in or out, right? So this was a dynamic where, oh my God, this is, what's happening in the US really matters. That's at the national level. Unfortunately, at the local level, that totally breaks down. Here's 2022 MSA GMP over 2019 levels. Correlation of 1.2% and R-squared is 0. From 2000 to 2019, it was a little higher, but bottom line is you're not seeing that dynamic. What drives individual markets is not the same thing that drives the national growth. You have to understand what your feeder markets are, what the demand segments are. It is not the same dynamics. So what we do at Lark is we build out markets that are specific. We build up models specific to each individual market to give us a sense of where those things are going to go for each individual market. And here's the same chart from a demand perspective. Bottom line is local economic growth alone does not predict whether a market is going to be good or bad. So here's our 2023 RevPAR outlook for the 60 markets that we track. What you'll see here, top chart shows 2023 relative to 2022, so year-over-year growth. Bottom chart is 2023 versus 2019. So top markets for 2023, a couple of those are going to be markets that have struggled to recover, like DC and San Francisco. Others are going to be markets that not necessarily have struggled to recover, just they've got some strength behind them. New York, you had a massive reduction in inventory related to the migrant housing. Houston, you've got the energy markets really accelerating and impacting that market. Las Vegas, you've got this great group dynamic and some other things. We're going to talk about Vegas a little bit more in a minute. RevPAR growth relative to 2019, it's not the same number. It's not the same markets, right? Here you're looking at Kauai, Florida Keys, Palm Springs, Palm Beach, Savannah, right? And markets like San Francisco, which were top here, are still bottom relative to 2019 because they hadn't recovered much. They have the biggest hole to fill. Taking a 5-year longer term outlook, let's take a look at 2027 over 2022 at the top here, or 2027 versus 2019 RevPAR. And what you'll see here, top are going to be a lot of the markets that failed to recover through 2022. San Jose, Seattle, DC, Portland, it's San Francisco, all towards the top. Bottom are going to be markets that did recover really well over the past few years, from Florida, San Antonio, Florida Keys, Kauai, Miami, et cetera. You get the idea. And relative to 2027, you're going to see markets, that are going to see strong growth. Maui, we actually think is going to be really strong through 2027, just not so much year over year in 2023. And we'll get to that in a minute. And then, and that just has to do with the wildfires obviously having a big impact. Palm Beach, Vegas, you get the idea. In Vegas, we're going to talk more and more about Florida Keys, Kauai. Most of these are heavy leisure markets where you've just seen this re-rating of ADR across these markets, and they're going to really outperform going forward. And then from a value perspective, over the next 5 years, 27 versus 2022, Dallas, Seattle, Las Vegas, Charlotte, and Denver are markets that we see having some of the strongest growth. You're going to see, effectively, Seattle is an interesting one in that it's more of a recovery. The pace of recovery to date has been sluggish. We're going to see that pick back up. The others are actually seeing some stronger growth, generally speaking. Vegas has a lot of things going for it, and we'll talk about that in a minute, I said. And then you're also going to see growth in Dallas and Denver and Charlotte, really driven by outsized macro factors that drive performance there. And then relative 2027, relative to 2019, our favorite markets are Tampa, Phoenix, Vegas, Nashville, and Dallas. Vegas and Dallas are the only two that show up in both of those top fives. I'm sorry, Vegas and Dallas. I think I may have said Nashville. Vegas and Dallas, the two that show up in the top, and that's, we've got some pretty solid growth to date, as well as continued positive growth. Whereas markets like Tampa, Phoenix, and Nashville have recovered really well. And while they're not going to be terrible going forward, they're also not going to be top 5 growers going forward. So let's drill down from the metro to the micro. And this is our tool we call Lark GIS, which I think will be incredibly helpful to anybody that is really trying to understand individual hotel performance going forward. So to do that, we're gonna kind of pick on Las Vegas. We've got a pretty positive view on Las Vegas, as you guys saw. I think it's a little out of consensus. So let's talk about what's driving that view. Well, number one, leisure orientation is robust. We all know that, right? People go there for a vacation, right? Number two is really strong group dynamics. So 14% of all demand to the market in 2019 was driven by the convention center. That's the highest among all the markets we track. That shouldn't be that surprising. We know a ton of conventions in Las Vegas. Pacing data is strong. We've talked about how strong pacing data is across the country. Las Vegas is no different. There is still upside to group demand with 2023 group demand levels. Year to date, still 9% below where they were in 2019. So you've got group upside. You've got strong group dynamics. You've got positive leisure. And then you layer in corporate transient, what we refer to as the new frontier for Las Vegas. Corporate demand indicators are growing at 2 times the rate of the US average. Economic growth, GMP, is actually number 1 of the 60 markets we track according to Moody's over the next 5 years. As you can see, Las Vegas over the US. Office employment growth, also over 2 times. Retail sales is more of a leisure metric, but it's strong. Population growth, you're seeing very positive net migration trends into Las Vegas. And then the 3 sectors that really drive corporate transient demand are all exceeding, from an economic output perspective, the national averages. This is all very, very encouraging for growth in corporate transient, segment that the industry hasn't really, that the market hasn't really catered to. But we think as that shifts, it transforms the market in a big way. Other thing that's going on, sports tourism. So Vegas has historically been blacklisted from professional sports, right? Limiting sports tourism to basically avid gamblers and the occasional UNLV fan. Well, that has done a total 180 over the past 3 or 4 years, right? The Golden Knights expansion team began playing in the NHL. In 2020, the Raiders moved from Oakland to Las Vegas. In 2025, the Oakland Athletics will move to Las Vegas. There's 2 potential NBA arenas being built, which will definitely lure an NBA team. And additionally, Vegas is now winning major sporting events. So in November 2023 will be the first annual Las Vegas Grand Prix. They signed a contract through 2032, where you're going to see the Las Vegas Grand Prix every year in November. 2024 Super Bowl, Las Vegas. 2028 Final Four, Las Vegas. We expect more to come. And on top of that, in a market like Las Vegas, we expect these events to have an outsized impact on pricing power because people really want to be in a market like Las Vegas for these types of events. They really want to be there because of the casinos, the gambling, all those other things. We think this is a huge win for Las Vegas over the next 5 to 10 years that is not accurately reflected in kind of 2019 or pre-pandemic, baseline data. Very, very encouraging. Then let's take a look at our RevPAR model. Here's our RevPAR model for Las Vegas. It's got a 99.2% R squared, just like the ones I showed you before. Dark blue line is the actuals from Las Vegas. This is not from the Central Research, this is actually from the LVCVA. And then the light blue line is our model. You can see how accurate our model has been historically, as well as where it's forecasted to go moving forward. You're going to see a couple of spikes related to those the races and whatnot, and the Super Bowl, et cetera. And then you'll see all the factors that drive our model here. Pretty meaningful numbers that are really encouraging to us. And then market is one thing, but what about within the market? And this is where our new Lark GIF tool really comes in. So what you're seeing here is a heat map of economic growth across the Las Vegas market. Darker is stronger than weaker, and this is 5-year forward economic growth. We've got data for 217,000 unique geographies. They're called block groups across the US. Data that includes economic activity, retail sales, office employment, meeting space, tourist visitation, population, net migration trends, for all of these unique geographies. We're not talking 60 markets, we're talking 217,000 built in. We have this data in the tool on an aggregate basis, on a per available room basis, because we've got every hotel in the US in this tool. We've got all the hotels under construction in the tool. So we've got a 5-year forecast that incorporates the change in inventory and change in supply. You also can map out the growth like you see here, economic growth. You can also map out the economic growth per available room. And then of course, we actually have RevPAR data just like this, where you can see what the RevPAR is by block group, et cetera. Super granular data. And within Vegas, here is the 5-year forward RevPAR growth outlook. And this is darker is stronger. As you can see, you've got a little bit of this is a 5-year forward. So it's not a compound annual growth rate, it's an aggregate growth rate, but you can see what hotel RevPAR growth is going to be. There's a lot of gray. Those are areas where there's no hotels. Where there's no hotels, we can't have a hotel forecast, right? But where there are hotels, we have actual forecasts. And what we're also showing you are some of the things that are going to pop up across the market that are going to help drive demand. The orange circles are new hotels under construction. We've highlighted those. But aside from the Fontainebleau, there isn't a lot of hotel construction across Las Vegas. And that's pretty encouraging for a market that's got all this good going on for it. Helios up here is a major medical center complex. The AllNet Arena and the MSG Sphere are 2 arenas, both hoping to allure an NBA fan or an NBA team, but they'll certainly lure in all kinds of concerts and special events and things like that. The A's Stadium is going to be down here. Uncommon's Las Vegas down there is a massive mixed use complex, including a lot of office space. And then you have the Boring Company Transit Loop, which is going to be underground throughout the entire area, making traffic less of an issue. Just a fascinating dynamic what's happening across Las Vegas. And what you see here across this map is an ability to see where RevPAR growth is going to be strongest across a given market. It's not just about the market, it's about within the market where you want to be. And our tools help you do that in a great way. We're really excited to be bringing this to the market because we think it's really going to change how people look at some of this data. With that, I have now spoken a full hour, so I'm going to stop. But before I do, for those of you that are interested, here's pricing for our individual reports: $2,000 for a single report, $3,000 for an annual contractor report. Access to our full platform is $45,000 a year. But I'm going to stop there. We've got a bunch of questions. Katie, do you want to jump in with questions? If you have to pop off, but you have any questions, feel free to email us at information@larkanalytics.com. I appreciate you taking the time. Thank you. Katie, why don't you let me know?
We got a few here. So do you think that student loan repayment will have a measurable effect on hotel performance as it relates to demand or price sensitivity in the near term?
In short, no. In long, I think it's a much more complicated answer that isn't going to turn around into short-term implications. I think the bigger issue is, is student loan repayment right now. What's gone through has been very limited in terms of easing of student loan repayments. So because of that, I'm not confident that we're going to see a massive shift. Obviously, there's been some gaps in student loan repayment because of the pandemic where things were, there was a lot of leniency afforded. That will change. But I think those consumers are generally extremely low price point and much more cautious. And generally speaking, we're seeing a pullback of those consumers to begin with. So I don't think it's as much driven by student loan. But to the extent that personal savings rates are low and that plays a role in it, sure, it will have a nominal impact, but it's a small component.
What is your opinion regarding why hotel occupancy is trending down as of late, even as TSA throughput is trending up? Is this an indication of shortening length of stay?
So we've certainly seen that. I think that what we're also seeing is throughputs trending up as short-term rentals gain more and more traction, which doesn't show up in the hotel occupancy data. And short-term rentals will always gain more and more traction during seasonally leisure sensitive or leisure oriented periods like late August. And I don't know that that's necessarily sustainable that's not a sustainable dynamic. It's more seasonality driven than anything else. But we're pretty optimistic that as we move through, the end of summer and into fall, that you're going to see corporate transient becoming a much bigger component of the hotel demand mix, and that's going to be very positive for hotels.
What attributes are impacting the divergence in market performance in reference to the 2022 versus 2019 slide chart?
It's a great question. Every market's different, right? The reality is basic economic growth hasn't driven market performance historically. You have to get into the details. What drives hotel demand in New York City is very different than what drives hotel demand in New Orleans, which is different than Miami, which is different than Seattle. And if you take the same metric and say, this is the metric that works for every one of these markets, you're going to get pretty crappy results, right? At the end of the day, New York is very financial services oriented. So yeah, maybe the tech industry is struggling, but if financial services is having a banner year, New York's going to do okay, right? New Orleans, it's going to be very convention calendar oriented. Miami, it's going to be leisure oriented. So what are the factors that drive leisure, from consumer confidence to personal spending to some of the other factors macro factors that we look at from a consumer perspective? Because at the end of the day, Miami's so driven by tourism that industrial production's up in Miami, that's not going to drive hotel demand, or at least not meaningfully. Whereas in St. Louis, that may be very relevant. Every market is unique, and if you apply the same factors to every market, you're going to get a forecast that's going to be lacking across every market. Our approach is finding the factors that are unique to each individual market and building out unique models to make them as accurate as possible, as opposed to taking a shortcut that just says, this is it, it's good enough. We don't do that.
Why assume productivity decline is due from work from home? Financial expansion put over $3 trillion in pockets of Americans. Perhaps employees are simply less concerned about losing their jobs and not motivated to work as hard.
And that may be part of it. You may be right. I think that, as we think about it, what has changed over the past couple of years? The big shift versus prior cycles has been work from home. Personal savings rates are now way back to where they were well below pre-pandemic levels, back to 2010 levels. So I don't think it's that people have the funds in their bank accounts that they don't have to worry about working. I think people want to keep their jobs. The great quitting period, or the great resignation, as people refer to it, is now ended. That has really subsided. So I don't think we're seeing that to the same extent, but you're still seeing these productivity challenges. So I think you can, through process of elimination, point to this being the one factor that is a little bit more unique over these past couple of years than all the others. But it's a valid point that it's probably not the only thing that's contributed.
What is the value of the 1.9% decline in productivity? Is it more than the cost of returning to the office?
That is a great question. And I would say the answer without being an office leasing expert, what the costs are for that. I think that there are a lot of costs to not return to the office, as well as costs to return to the office. The cost to return to the office is a combination of not only the cost of the lease, but also the cost of potential employee turnover for people that don't want to come back to the office. The cost of not returning to the office may have to do with productivity, coupled with culture dynamics that people may not, want to avoid, I guess, or walk away from. So I think there are pros and cons to everything, but when you see the greatest productivity decline in in one record from the BLS over a 2-year period, it raises eyebrows, plain and simple. And productivity, 1.9% is a big amount. That is a big amount. I mean, if you think about GDP, we're talking about billions and billions of dollars of lost production.
What was the year-over-year growth in leisure demand prior to 2019?
I don't have that off the top of my head. I can probably pull some of that data for you. If you email me separately at information@Lark Analytics, I'll try to get you some estimates. It's always funky. I mean, when it comes to the corporate group and leisure dynamics, I can tell you how we estimate it. But again, it's just an estimation. It's our best guess. We don't think that booking channel alone is the way to look at corporate versus group or leisure, because booking channel, I may be going to a convention and booking on brand.com because I'm not staying at the convention center hotel. That doesn't mean I'm a corporate transient traveler or a leisure traveler. I'm actually a group traveler. I'm not going to show up in the group in the group system. Same thing, you've got the leisure, the mix of people staying for convention and then staying for a long weekend. You've got leisure components to that, or a business trip and staying for a long weekend. All those types of things continue to weigh. We don't think booking channel is the only way to look at it. We look at things from a booking channel perspective, from a day of week, from a length of stay, and by market. Knowing that chances are, if you're staying for 5 nights over a long weekend in Miami, you're more likely to have a leisure component than if it's in St. Louis, right? And looking at some of those dynamics that play out. So we do all of that math ourselves internally, getting data from the big data providers, to really get an estimation of where things are. We do that once a year on an annual basis, which is why I don't have what 2023 is yet. We'll do it at the end of 2023. And go from there. But generally speaking, that gives you a sense of of how we think about it. I don't have what it was prior to 2019 levels in front of me right now, but if you email me, we should be able to get you that.
How strong could some of the currently underperforming markets be in 2024?
That's a good question. So here's what I think is really fascinating. So it depends what you think about what you mean by underperforming. Is Miami an underperforming market, or the Florida Keys an underperforming market? These are two of the best markets relative to 2019, but the worst markets relative to 2022. I think 2023 is going to be the year of normalization. I talked about that when we talked about the demand segment mix kind of stabilizing from 2023 forward. It's the same type of thing, that we're now going to be comparing to 2023 much more so than we will be comparing to 2022 or 2019 going forward. And with that being said, if you're referring to markets that, our view is the markets that are going to be strongest over the next, call it 9 to 12 months, are going to be more corporate transient and group oriented and less leisure oriented. So if you're saying, hey, markets that are underperforming are those like the Florida Keys and Miami and other markets that are leisure that are leisure skewed, I think they're probably going to continue to lag. That doesn't mean they're bad markets. Numbers are still going to be solid, but they're going to continue to lag because they have less corporate exposure, less group exposure, and that's what's going to drive outperformance across the industry over the next, call it 4 quarters or so. Whereas if you're talking about markets that have lagged relative to 2019, we think you're going to continue to see strong growth because those are the markets that are recovering on the corporate front.
What cap rate are you underwriting to?
That is not a simple answer. Cap rates are based on individual assets. We analyze market level cap rates at the national level and say, here's what the historical cap rates were, and we have all of that data in our reports if you're looking to purchase one.
Can you talk a little bit more about the NYC migrant situation? How many rooms are being taken from housing? How do you factor that into your supply growth projections nationally? How long does your base case assume those rooms stay migrant housing? And how impactful is the answer to that question on NYC RevPAR projections?
Oh, those are great questions. So it's impact. Our estimate is about 20,000 rooms are offline for migrant housing right now. We don't estimate that all of them are offline permanently. I think we estimate somewhere in the ballpark of those 20,000, 5,000 are permanently offline. And the other 50, somewhere in that ballpark. I'd have to look at the actual numbers. It's in our New York City report. But somewhere in the ballpark of 5,000 are offline permanently. That number could change. It's just a percentage of the total. And we think that the others will come back online, but it's hard to know exactly when. And when you think about 20,000 rooms being offline right now and taken out of inventory, it has a huge impact on New York, a huge impact. You know, we're talking, this is roughly 15% of all supply in New York City. So, and it's not, you know, the Starlight Motel. We're talking about 1,000-room hotels in Midtown Manhattan, branded hotels in downtown Manhattan or by the airport. We're talking real properties, real hotels. So it's definitely having an impact, and it's inflating occupancy, ADR, and RevPAR across New York City in a favorable way. We don't know that it goes away anytime soon. It's hard to know exactly what that's going to be because at the end of the day, these contracts are generally month to month. So there's no guarantee that they're long-term, but we also don't see the city government doing anything to try to make a long-term solve that way they wouldn't need the hotel usage. So it's hard to say that it's going to really change. But we've looked at a lot of these contracts, and the bottom line is we think that these hotels, while we're not sure how long the migrant issues will persist in New York, we don't think it's ending overnight. And 20,000 hotel rooms is a large number, not only for the New York City market, but for the country as a whole. It impacts supply growth by about 20 basis points, 0.2%. So pretty meaningful across the US.
What is the yearly forecasted inflation rate implicit in the forecast models?
Every year is different. I think we walked through some of the numbers that we saw from Moody's Analytics, but we've got things gradually moderating to under 3% going forward.
When it comes to the 5-10-year view of Las Vegas, do you factor in climate change dynamics like excessive heat and water scarcity into your outlook?
That's a great question. So we have not. And we do factor climate change factors into other markets. In fact, our GIS tool has sea level rising data as well as flood zone data, things like that, that can be helpful. But when it comes to rising heat, we have not, I mean, our approach is very data centric, and we have not seen a correlation between rising prices, rising temperatures in Las Vegas and deteriorating hotel demand. There may be a break-even point where that plays out, but we haven't seen that yet.
Thoughts on the Memphis market?
We like Memphis. It's one of our favorite markets for top line growth. There's not much supply growth in Memphis. Downtown Memphis is particularly strong. There's a lot of good things going on. Good mix of leisure, corporate, and group. What I will say is 2019 may not be the right baseline to look at Memphis, because 2019 the convention center was under renovation, so you didn't get that convention baseline that you would normally get. Obviously, that's come out, and we're seeing convention bookings massively up in Memphis relative to 2019 levels, and that gives a great pricing power across the market. So it's a market relative to 2019 that we think is going to continue to be pretty strong.
Have you studied future extended stay hotels demand versus not extended stay hotel demand?
You know, we've done a lot of work on extended stay for a lot of different clients. Katie's smiling because she's like, yes, we have. Generally speaking, the factors that drive extended stay performance are different than the factors that drive the rest of the hotel industry to a large extent. So it gets much more granular. we've looked at a lot of different things. One of the factors that we think is very relevant is net migration trends, which, not to tag it again, but our GIS tool that shows you how population growth will change within a market over the next 5 years and where in the market is a great indication of where extended stay products will probably perform particularly well across a given market. But there's a lot of different factors. Without, we have not published an extended stay forecast for public use. So I don't want to comment anything specifically on our general views on extended stay, beyond saying that we have a pretty favorable view on the on the segment.
Any insights on the outdoors leisure travel segment?
I wish I had anything that exciting to share. Obviously, we're seeing things like I guess when you talk about outdoors, you're probably thinking about two different things. One is just the outdoor enthusiast, and then two is more of the glamping type accommodations levels. We think that glamping type accommodations levels are here to stay, and they'll continue to gain traction. We think the outdoors enthusiast will continue to travel as they always have, but I don't know that we're seeing an inflection point where that type of traveler is now seeing massive growth. We just think it's a continued trend.
At a high level, do you have any idea why San Antonio has such a draconian outlook in the LARC forecast?
Sure, it's real simple. San Antonio's outlook is driven by, I would say, two primary factors. Factor number one is the local economy in San Antonio is primarily driven by government and military. And when you're driven by government and military, you have a very stable demand base and very stable pricing. That is not likely to change anytime soon. That's why San Antonio didn't fall very far and was back to 2019 levels very quickly, but growth will be slow moving forward. The other side of that is the convention booking pace in San Antonio is sluggish. You might think San Antonio, it's really strong. Houston, Austin's under renovation, Dallas under renovation, San Antonio should be the strong one. The people aren't choosing, these groups aren't choosing, to stay in Texas necessarily. They may say, oh, we'll go to New Orleans, or we'll go to Las Vegas, or we'll go to Phoenix. San Antonio isn't winning those, and seeing really robust pacing. Pacing is modest in San Diego. And I think between those two factors, it's weighing on things. That being said, if you've got a 1,000-room hotel with 200,000 square feet of meeting space, you're basically a self-contained entity where you're really focused on generating your own demand rather than relying on outside demand, and you may be fine. Or if you're, a leisure-oriented hotel on the Riverwalk, something like that, you may be fine too, and perform a little bit better than the market overall. But the market overall isn't going to see a lot of growth.
How do you feel about hotel performance given the recent legislation that is likely to wipe out Airbnb as we know it in NYC? I believe it requires hosts to be present in all the rentals now.
So the legislation's not new. Legislation's been around. This is all about enforcement and battles with Airbnb, legal battles with Airbnb. Katie, you've done a lot of research on this. I don't know if you have any insights you want to illuminate to anybody, but in short, we do a lot of work on short-term rental regulation. It's in all of our reports. We try to understand what's happening across every market from a short-term rental regulation. That's one of Katie's roles, is to spearhead all of that primary research. And at the end of the day, what's happening in New York City is nothing new. It's all about enforcement. And we will see how the enforcement really unfolds. But it's encouraging right now, should be a positive for New York City. It's not necessarily what we're seeing across other markets, where there's a lot of other markets where there is no enforcement. New York City's had Airbnbs effectively illegal. Short-term rentals have been illegal in multifamily buildings since 2011. This is nothing new. The challenge has been the enforcement of that law. Well, now the city is finally, after lots of lawsuits and legal battles, able to move forward, and Airbnb is complying. And you're going to see, without the resident home, it has to be at least a 30-day rental, so it's not deemed short-term rental. It will take a lot of inventory out of the market that will be permanent, and that will be positive for the New York City market in general. But again, that's on the margin more than anything monumental for New York. It's encouraging. It's not a bad thing. But Airbnb hasn't had the effect on New York City hotel revenues that the media would like us to think.
Thoughts on I'm not sure if I'm saying this right, but Cupertino growth over the next few years?
Cupertino, yeah, Cupertino is not a market that we track on a regular basis. It's obviously within Silicon Valley and part of the San Jose market. What I can tell you is San Jose overall, we see robust growth, really just driven by corporate transient continuing to recover. This is a corporate transient oriented market. We think that's positive. It's going to continue to grow, but off of a very low base. San Jose is not one of our favorite markets relative to pre-pandemic. It's not as bad as San Francisco for a variety of reasons. But and I would imagine Cupertino, without digging more deeply into it, is going to see similar dynamics. But in our GIS tool, we could play around and see exactly where the growth is most likely to play out across the market.
What are your thoughts on the Portland, Oregon market?
Portland is a market similar to San Jose that's recovering from a lower recovery to date. Portland, we actually think, is continuing to do better, but it's still going to face a lot of challenges. Similar challenges to what we're seeing in San Francisco, just not as bad, coupled with no supply. So it's hard to be overly excited about Portland right now, but the growth profile is going to be stronger off of a lower base than we'll see for a lot of other markets.
Is there value in factoring credit card balances into consumer spending for hospitality industry?
Yeah, I mean, I think understanding where, yes, in short, we look at consumer debt levels, as a driver for leisure transient demand. And that debt level isn't just credit cards, it's also mortgages or car payments, other things. I don't think credit card alone is sufficient, but if you look at consumer debt levels as a percentage of income or percentage of assets, it can be very helpful. And again, it goes back to kind of personal savings dynamics and things like that.
And right now, this next one is our last one.
Great.
Is there a correlation between Airbnb occupancy rates and hotel occupancy rates?
No, none whatsoever. Now, in certain markets, it's higher than others, but across the US, we estimate that short-term rental revenues through data from AirDNA equates to about 4.9% of hotel revenues. Right? 4.9. Right? So we are not talking about massive. This is not a huge component. It is very much on the margin, and it is very, very, very leisure oriented. So there are markets that are leisure oriented where this is dominant. There are markets that are not leisure oriented where we're looking at less than 2%. So I think the focal point on short-term rentals is a media-driven dynamic that, does it impact things on the margin? Sure. If you're a leisure-oriented property, you're a hotel in Virginia Beach, sure, right? It's going to have an impact. But focal point in New York or some of the other big markets around the country, it is marginal. It is not at the forefront.
And
Great.
Still more questions.
All right. Well, thank you, everybody. Appreciate you joining. And I hope you all have a wonderful day. For those of you that, are still on, if you're interested in connecting at the HAMA conference or at the Phoenix conference, just reach out and we'll talk soon. Thanks so much and have a wonderful day.